Hey, good evening, ladies and gentlemen. Thanks for joining us on this Dr. Wellbeat and Us episode. Today, I have Dhruv, the CEO of Syfe, with me today. And Dhruv has a very illustrious career in finance, and he left it to start this Roboadvisory and offering to a lot of users now in Singapore. So I'm very honored to have him here on the show. Hi, Dhruv.
Hi, Alvin. Thank you so much for having me over today.
Okay. So it's very encouraging that we started to see more innovators, disruptors, like trying to change the landscape of finance. And you being coming from finance yourself and having a great career, why do you choose to go on this route, setting up your shop, trying to do something different from what finance have been offering?
Yeah, I mean, it's a question which I think I get asked often. I actually really enjoyed my time in finance. I was a portfolio trader at UBS. I rose up the ranks very quickly. I was a director at 27, so set on the right trajectory. So I really enjoyed it. I think UBS was a great learning ground. Uh, for me personally, the only thing that bothered me somewhere was what we did in finance, or what I did at UBS. It was a bit restrictive. Like you were somewhere working for, I guess, the 0.01% of the world, trying to make it the 0.001% of the world. And though I think this seemed a lot of fun, I guess, in my early 20s. But as time passed by, I realized for me personally, satisfaction meant something more. And for me, satisfaction meant doing things which have a wide-reaching impact. Now, whether that is building a platform like Syfe, which is helping other individuals, or creating jobs and creating employment opportunities, which we do at Syfe, right? So I think for me that was the driving factor. I thought we were doing all this really cool stuff in the world of in banks, but the average person on the street is not having access to it. So that is the net story of Syfe. I think there are two parts: a personal side of creating employment, and a professional side of actually getting some of the best practices that we have in the world of finance, making it more accessible to the masses using technology.
Okay, thank you for sharing. Would you agree that you're now working more on the ideals, right? And it is a luxury to be working on the ideals. Someone who have not achieved much in life probably would have to take on a lot more risk to start up, to do something like this,
Yeah.
to do some technological startup, right? Do you agree with that?
Yeah, yes and no. I mean, I think the ideals part, yeah, I think the ideals part, definitely. I think at some point in your life, they hit you, whether, sometimes at 25, sometimes at 35, sometimes at 45. But I feel the risk is always there and it's never there. I think it's just about, the perception that you build of risk, right? Because one school of thought is that, when you're very young, you have your life ahead of you, so you can take the risk, right? And the other school of thought is, oh, you've spent 10 years, you've already saved enough, so now you can take a risk, right? So I think it's a very person to person phenomenon. But I would agree that definitely having a chance to do something that you believe in, it is something that even keeps you going on the days which are not so good days. And we all have good days and bad days, right? So I think from that angle, yes, I would say I'm privileged. Yes, there are days I'm tired, there are days I'm sleeping at 3 and getting up at 7. But it's exciting because we are building something which is getting a genuine impact. So
The challenges just keep coming, right? Regardless of what your status
yeah,
is.
yeah. But if you start embracing the challenge, right, and then you ask, okay, you have this option, or you have an option to go to a conventional job. I think for me the choice has always been a no-brainer choice, and that's why we walk down these paths, right? So
Okay. So Syfe is offering robo-advisory in Singapore, right? And why do you pick Singapore as a choice for robo-advisory services?
yeah, I think it's quite a good question, right? I think a couple of factors go into that decision, right? So I think firstly, I think the audiences generally in Singapore are savvy enough to give a chance to new players to come and showcase their skills, right? I think in some of the other geographies there is a lot of love for banks, where even if banks are charging you 3% for something they should do for free, people just feel safer, right? So I think the savviness of the audience is something which is very, very commendable, right? They will compare with the best options. They will compare you with the other provider and the other provider and the other provider. So in a way, it really helps because you are in a somewhat a challenging market. You always have to be at your best. You have to always innovate. You always have to launch. You have to be at the cutting edge of technology. So I think the first part, and I would say perhaps the most important part, is the user. I think the second part is also, I would say, regulation. I think generally, both the MAS, as you know, we are CMS licensed by the MAS, as well as the broader ecosystem is very supportive to fintech. So I'm quite confident across the next, 5 to 10 years, you will see some significantly large companies come out of Singapore, which will be competing with companies which have come out typically in the US or to some extent, within China. And this blend of human capital plus a favorable regulatory environment will be the reason for that. So those are, I would say, two of the key reasons why we chose Singapore.
Okay. So thanks to our government for creating such an environment and the infrastructure, right? Because the thing that I have in mind is that Singapore is always a very small market because we have like 5.5 million people, right? And the challenge is that if we have robo-advisory where the fees are a lot lower compared to other financial products, right? So it would be quite hard to get that scalability, which means is there like plans to use Singapore more like a HQ in Asia Pac and reach out to other countries? But I also understand that there are challenges because finance is not as scalable like some e-commerce products because it's highly regulated, right? So if you want to move to another country, you need another set of licenses and things like this. So that always makes me wonder, right? Why choose Singapore when the market scalability is a lot more limited?
Yeah, I mean, it's a fair concern you raise, right? See, I think any company, right, no matter what domain they are in, they would want to scale. Now, take, for example, even a DBS, right, which is so prevalent and so popular in Singapore. They too have scale. They have like, branches and banking services across different jurisdictions. I believe given the fact that Singapore, the nature of the market is such, that it will test companies and startups to actually outperform and excel. The belief which a lot of companies hold, and at least I can speak for ourselves, is that if you can get it right in Singapore, there is a possibility that you would have learned enough of your way to actually go out and replicate this model in some of the other markets, right? So is the concept that Singapore is the HQ and it becomes a significant market? Yes, to some extent. I think any company which is based on technology has this privilege to grow out and expand in other markets. But as you correctly said, every market that you go to, they'll come with own regulatory challenges. So should we do it? Would we do it? I think it's something that time will tell. But on our side, of course, we do want to get out in other markets, and we will be present in other markets, because I think once you build this whole technology solution, I think it will be a waste to some extent of not using the same learnings and same set of data and information, and then use it to build better quality products, not just in Singapore but also in other geographies.
Okay. So the next question I have, let's come back to Singapore then, right? And focus on Singapore. Sure. What do you see as a common problem when it comes to investing for Singaporeans?
Yeah. So I think the first and foremost problem I see is the affinity for cash. I mean, everyone just loves keeping a lot of cash, right? And just to give you, I'm sure you've seen these numbers before, but if you look at Western world, right, developed countries, Singapore's a developed country, right? So it's unfair to compare, let's say, Singapore with broader Southeast Asia, right? And in that aspect of things. But typically, like developed countries like Europe or US, right, their saving rates as a function of individual net wealth is somewhere in the 15 to 17% range, right? Now in Singapore, this number is like beyond 40-45%, right? And I think this is not just a Singapore problem, this is an Asia problem. Like, when I was also growing up, my parents are like, put money in the bank, put money in the bank, put money in the bank. So what has happened now is that, across the region, you have this setup where almost half your wealth is in a bank account, which, as you know, now is not giving you pretty much any interest. But in general, the cost of living, inflation, etc., still keeps on rising, right? So by and large, you are in this environment where the value of your wealth is depreciating by, give or take, like 2%, a year. So a lot of people don't really realize this, but the $100 kept in the bank in 20 years, it's not going to become 101 because, from a small interest rate, it's actually going to become closer to like 50 because the purchasing power of that money will actually reduce, right? So I think the first and foremost is actually, that love for cash, which needs to change. Otherwise, people, the value of money will keep on decreasing over time, that people will not come into play. The second thing, which I have seen in Singapore, a little bit less than at least what I saw in Hong Kong, where I spent a fair amount of my career also, was that there is still this tendency of trading in, trading out, timing the market, trying to call the market. And by and large, we believe, all right, if you're doing it with a part of your wealth because I know, it gives you an adrenaline hit, it excites you, and so on and so forth, it's fine. But excessive tinkering, with your own portfolio, by and large, over time has shown to have negative results, right? So I think if individuals can start just the habit of investing, and b unless they have a very strong time and resources to do the research and have qualitative calls day in day out, and trust me, unless you're doing it full time, you really can't stick to a sort of an investment plan. I think if those two things happen, I feel the broader growth that individuals will experience over a period of time, because I presume most are saving for a long period of time or investing for a long period of time, will be significantly higher.
So I hear that you are saying that Singaporeans are very good savers, or they are gamblers, right? They like to
small number gamblers, very very big, very large numbers big savers, right? Yeah. So small numbers gamblers, I guess the same people who are willing to pay $150 to go to the casino. but
I'm just joking.
Yeah. But by and large, I would say I think savers, but also saving to a point where we say this like sometimes missing the forest for the trees, right? So you might keep on building these assets, but you're like some people say, oh, I need $1 million, right? But you have to realize today what you value $1 million, in 20 years, what $1 million will buy is what today is $500,000, right? Something of that sort. Is something that I feel people sometimes forget.
I definitely can vouch for that because when I look at my family and my relatives, most of them, they don't invest their money. They will just save and save and save. They are not really spendthrift. They want to buy a lot of stuff. So they keep a lot of cash in bank.
Yeah.
So
what do you think, like, for at least for me, while growing up, it was cultural because, as Asians, your parents always tell you to like save. You think it's a similar reason in Singapore as well? Or do you think it's a fear? Like, what do you think is the reason for that habit?
I do think culture plays a big part, right? Because that is how I was brought up as well. You need to save money for rainy days, right? There's always this. You can also say that that's being risk averse because you just want to hedge against any unforeseen and unfortunate event that may arise in the future. So you always want to have something prepared. Better be sorry than anything, right? So that is
to believe, like, save some, like keep some money. It's not like you put 100% out there, right? But do something, right? Like at least I would say, I mean, now maybe the rates are low, but at least last year I was saying, okay, if you're not sure, invest in SSBs, right? They were a great tool. Now different story with the rate cuts and all that, but at least do something, right? Because otherwise, that wealth you have, it's just deteriorating value, right? So
it's worse now because of very record low interest rates. It's very hard to get a good, even the decent savings rate on your cash.
Yeah, which is actually, I think, one of the reasons why, Alvin, what we've seen, and somehow for us, like the last 3-4 months have been incredible in terms of user growth, asset growth, and so on, because I feel people are realizing that, hey, I'm putting this money, this is like, it's basically, it's like it's 100, after like 10 years it's going to be 101, right? So maybe let me do something about it. And that's why people are looking at solutions which are largely automated, largely passive in nature, and somewhere managed by someone else. And we spoke about regulatory. I think one thing that we sometimes forget is also technology, right? Technology plays a very big role, right? Give you a simple example, like 5-7 years ago, to onboard a client, you had to go and do a paperwork and so on and so forth. So it would just not justify if you have to charge 50 basis points as fees, right? But today, with, let's say, a MyInfo based login, some of those steps have become much more cost effective and much more accessible, not just for providers like ourselves, but even for the consumers. And I think that's a great, a positive advancement of technology, so as to speak.
So is there one reason why you started Syfe is to help Singaporeans invest more conveniently and easier, removing a lot of the resistance and the barriers along the way?
Yeah, definitely. I would say our goal at Syfe is to democratize investing and savings. And I use the word savings also because, in my view, savings is somewhere the lowest type, lowest risk investment, the lowest risk, lowest reward kind of investment, right? And I feel like often people, like, they decouple these two. They're actually intertwined, and you will see, if the rates remain low, a lot of people will rethink what is saving, what is that, right? And I could argue that if you invest in a Singapore savings bond, that is technically still saving, right? So it's a perspective that people have. But yes, that was one of the reasons why we started Syfe.
But we all know that robo-advisory is still pretty new in Singapore, right?
Yeah.
How do you like encourage someone to even consider it, right? Like, for example, I'm not sure whether my mother will be a target audience for you guys, but
Yeah.
how would you convince someone like my
Yeah.
mother to invest in a robo-advisory?
It's a great question, right? And I mean, especially like if you go to slightly like older audiences, right? For them, I think it's also a bit trickier because they're generally a bit risk averse and all. But it's quite interesting. Our youngest customer is 18. Actually, it would be 16, but we legally can't take anyone below 18, so we did not take the 16-year-old. Our oldest customer, I think, is 72 or 73, right? So they are like older people also who have like onboarded. It's actually quite impressive, right? They've onboarded through a digital platform and so on and so forth. I think what we did was we do focus a lot on investor education. At least when it was allowed, we would do a lot of offline seminars, right? So that people can come complimentary seminars to understand about what we are offering and what products we have. Now a lot of this has converted to online seminars, right? Like perhaps this one. We focus a lot on content where we educate people and we tell them to understand why inflation is bad, why having excessive cash is bad, so on and so forth. Then we touched on this briefly before we started, was that we actually do have a human team as well, which supports our digital solutions. Now, the purpose of this team is not to become a stock picker, etc., because we don't adhere to that school of thought. But they will actually help you better understand how these products suit your goal and what stage you're in life, right? And lastly, I think what we do is the thing that we do at Syfe is we spend a lot of time in building products which cater to user needs, right? So if you look at our flagship product, which is RE, which is the risk managed investing, the reason why we built it, I mean, because was if I went and told you, hey, Alvin, do you want 5% return or do you want 10%? Of course you want 10%, right? Everyone wants 10% return. But the premise we had is that somewhere the fact is that returns can't be predicted, but risk can be managed. So what we did was, rather than everyone talks about returns, but we actually built a portfolio that our first offering is where all you choose is what is your risk level, how much are you willing to lose. Now, you will not lose that. We don't want you to lose that. We know if you lose that, you'll be unhappy and you will leave. But somewhere having some sort of a psychological uh, comfort, that
Preparation.
one of my kind of worst case scenarios, right? I think gives people a lot of comfort. And this really came to light in March when we had that massive correction in the markets, right? We actually hardly saw withdrawals, and all our portfolios were within the prescribed threshold of risk levels, right? So I think as a user, that gives them some comfort, and we are hoping. I don't think there's a secret sauce, like one thing that will change your mom to invest, but a bunch of these things done together, I think over time they have an impact, right? And now we are seeing many more individuals who are in their 40s and 50s also investing with us, not just the younger audiences, and I think that's a very encouraging sign.
Okay, so basically, is what you're trying to say is that to assure them that their money will be well invested, will
Yeah.
be kept safe, right,
Yes.
and to build up the confidence in the
Build
service.
confidence, yeah, and keep it transparent. Like there is no like entry charges, like how ILPs, you're 5% gone on day one kind of thing, right? So there's no entry charges, there's no exit charges. There's a clean dashboard. You can withdraw anytime. We are regulated CMS licensed entity. So assets are saved in custody. So all those little things, right? I think they are additive in nature, right? And I think the industry we are in, you need to have these multiple things than just this one thing, because I don't think that works anymore in today's date and time.
Okay. Um, in terms of, I'm not talking about competition against like other robo-advisory, but I think as a whole, robo-advisory also have competition with human advisors, right? They have an army of them, and they have been very established for decades right here in Singapore, right? And every day, at any moment, there are a lot of advisors out there, closing a lot of AUM deals and things like this, right? So and given that robo, usually you have to wait for the customer to come to you, right? Or the most you do is some outreach. So on this note, do you feel that you're being shortchanged, or or is a disadvantage to robo advisory?
Not really. I mean, I want to believe that the world we live in, customers will get more and more savvy, and they will be able to identify the good from the bad. So for me, the ideal scenario is that some random advisor goes and does all the pitching, and then the customer realizes the value of investing, right, and then finds the right value with us, right? So I believe that there is room to some extent to coexist, right? I think advisory, in my view, the true sense where a human advisor is getting better at giving you a better portfolio, I think that's a little, I guess, overrated, right? I mean, I don't know if I can share my screen because I have this little slide which I can
sure.
show.
Go ahead.
Yeah. Let me see that.
Yes,
if I
please.
can.
Yeah.
So
while we're waiting for the screen, we are now probably about the middle of the interview. So if you have any questions for Syfe and Dhruv, right, you'll be able to address them, leave them in the comments, and we'll probably answer some of the questions at the end. Right. Over to you, Dhruv.
Yeah, so this is an example, right, which is like a very popular SPIVA report, right? It's publicly available information, right? Now, if you look, right, over time, right, these are all these active funds, like the human touch and human advisory, right? Now, over time, in the last like 15 years, only 10% of them have outperformed, right? And you're paying a significantly higher fees and so on and so forth, right? And I think I can go back from my days in banking to tell you why this is true. You go back, if you went back like 15, 20 years ago, one of the key thing, Alvin, was there was a massive information disparity, right? Where as an active trader, or even as banks and all, you were privy to information which went out a bit later to the broader audience, right? And it took some time for people to catch up and get grip of it. I guess now the most powerful weapon in everyone's pocket, right? Everyone's got WhatsApp. Everyone knows everyone knew when Wirecard, CEO was under, allegation and so on and so forth. So I think that gap or that edge that so-called active investors have, it's widely reduced. I'm not saying it's zero, but it's come down to what you see on your screen. So if you think that an average, advisor can actually bring that edge, it's very unlikely. Right now, that edge is only left with some of the very, very large and very, very, I guess, elite companies out in the world, right? So what you can do on your side is definitely remain passive, like trust the numbers. B, more important, try to keep your cost basis low. Because that is one guaranteed cost. If you can save 2% a year by not giving advisory, that is 2% you have guaranteed, gain, right? And again, over 10, 20 years, that number becomes very significant. So if you can somewhere keep your cost low, you can, and if you can kind of stick to your plan, right? And you can allow it for everyone to stick to your plan. I think then you are much better off than an active approach, right? And I would always encourage, if you have doubt, I would suggest put equal money in both, give it 2 years, and then don't give it 2 or 3 months, because in that time anything could happen. Give it 2 years, right? And then I think the choice will become very, very evident to you in that scheme of things. Yeah.
Okay. So basically, you're saying that the information age is eroded over the years, right? Given the boom in the internet and the massive availability of content and information, so it's very hard for you to beat the market, right?
Beat the market, yeah. I feel the only place where you can beat the market is, if you're dealing in some emerging markets and so on and so forth, or frontier markets where, that information is still, broken. But if you think that you'll have an edge on someone over Google or on Microsoft or an Apple, I think then, you're definitely shooting ahead of yourself, right? Let's put it that way, right? So.
Okay, and that's why keeping a cost low is the most sensible solution going forward, right?
Yeah.
Instead of alpha, right, is to reduce your upfront cost.
Absolutely. We promote the smart beta strategy, is what we say, right, in one of our portfolios, right? So we think like the alpha thing is a little thing. And again, if you strongly believe that you can generate alpha, my suggestion to you, especially for some of the new and coming traders per se, is that let 80% of your investable amount be managed. 20%, play with the alpha and do it for, do it sustainably for time. I mean, don't do it for, a month and say, oh, the last month you would have bought anything, you would have made money, right? Like you have to really, be really bad in the last 1 month to lose money. But if you do it over time, you will realize that it's very tough. And I'm telling you this by being a banker. Like I tried active trading for my time and it wasn't worth it, right? I mean, I tried to game and time the market. Just, I mean, even within sitting in the banking infrastructure, it was something which is really not possible anymore, I think.
It's getting tougher.
It's
Very,
getting
very tough.
absolutely. And it's not worth it, right? I mean, you don't want to lose your sleep for that extra 15 basis points, right? So
yeah. Okay, so let's talk a little bit about the portfolios that Syfe is offering, right?
Yeah.
I briefly saw there are 3 types, am I right?
Yeah. Yeah, actually, sorry, I should have just probably kept on this. Yeah. So do you see my screen?
Yes, I do.
Okay, great. Yeah. So let me just get to the portfolios, right? So we are basically in 3 portfolios right now. The one on the left is Syfe Global. This was our original portfolio. This is typically, if it's like my first portfolio, it's great because it's actually bonds, equities, and gold all into one. And what we do is that here users are supposed to just come and choose a risk level, because as we mentioned earlier, risk is the only thing you can really control. So once users choose a risk level, we not only build portfolios, but we actually manage the risk on these portfolios. So what that means is that we will, manage the components of, equities, bonds, and gold, so your risk remains intact, right? This is like a true wealth management solution, right? Where we are managing the risk for you, essentially giving you high quality risk management advice, what is typically reserved if you have millions and millions of dollars, now democratized thanks to technology, right? The second offering, which we launched recently, this is the Smart Beta offering, which basically is a pure equity offering. And this we launched because a lot of users said, oh, I have CPF, I have SSBs, that's all my kind of safe assets. I want, for my 20% or 30% of my wealth, I want to take high risk. I mean, this is a long-term thing. Over long run, everyone knows that if you invest in equities over a very long run, you will end up winning significantly more. So for them, an equity 100 strategy makes a lot of sense, right? And this is an interesting strategy, focuses heavy on tech, and has done extremely well, since we launched it a few weeks ago, right? And the last one, and this was a very interesting one, which was again a bit localized and something very unique to Singapore, was the Syfe REIT Plus, which we built alongside SGX. So this essentially tracks the iEdge SREIT 20 index, and here you have an option of again 100% REIT tracking, and or an option to manage risk, where we decrease the component of REITs and add bonds in. Now, this is targeted more at individuals, who like the dividends, because, even after the whole, dividend cuts and all, it's quite an attractive proposition, because again, if you look at what your bank interest rates are, I mean, the REIT dividends are anywhere between 10 to 20 times of that number now, right? So I think it's quite an interesting proposition and continues to do very well for us.
Okay, I have a lot of questions on this, right? And I think that the audience are probably more interested in this area, especially. So how does it work? You mentioned about the risk that the user would need, or the investor would need to set first.
Yeah.
And do they figure out their risk level, and then you recommend one of these 3 portfolios, or how does it work?
Yeah, so the risk aspect is largely for the global portfolio, because the global portfolio is where we are managing the risk, right? In the equity 100 portfolio, we are not really managing risk. Of course, we are trying to get a higher Sharpe ratio, i.e. a higher return for the risk you take. But this one will always and always remain 100% invested in equities, right? So the risk management is something that we do for our global portfolio. Also, we do it for our REIT portfolio. So in REIT portfolio, it is just one button, risk on or off. If you say risk off, then essentially it's 100% tracking to REITs. If you put risk management on, it will decrease the REITs component to add on, bonds to manage the risk of the portfolio, right? For the global portfolio, the way how users identify their risk level is through a series of questions which we propose. Once those questions are acceptable, we suggest a risk profile to a user. This basically is a number between 5 and 25. What that is essentially what is the risk, or how much are you going to lose. Now, of course, we don't want you to lose. We know if you lose, you will leave and you will be an unhappy customer, which we don't want. But because I can't really predict returns, I can manage the risk. I'll manage your risk. So somewhere your downside is protected. And so we call it the downside kind of protection strategy per se, right? And based on that risk level, our goal will be to maximize the returns for your portfolio.
Okay. So which means investor can choose which portfolio they want to invest in.
Correct. Between these three options, because see, the equity 100 has a different purpose. It's more about, just adding up your equity component. The REIT has an income purpose largely to give you passive income, right? The global is the one where, it's like more like the core portfolio where users can come and choose an option. And depending on their preferred risk level, we will be able to, build portfolio for them and then subsequently manage it for them.
Okay. So would there be any guidance to help the investor to choose which is more suitable for them in this case?
Yeah, absolutely. So there's guidance also while onboarding, but because every user case is unique and so on and so forth, there's a complimentary, financial consultation session, which is done with human advisors, where we can, it's our team, which is done by people with excellent pedigree, right? They've worked with the big banks as Citibank, DBS. The person who runs it is former private banker at Goldman Sachs. So we are somewhere trying to give that level of service to a much wider audience. You can set up a complimentary, consultation call, and understanding what your goal and purpose is in life. We'll be able to guide you better. Now, the online path also helps you to choose, but of course, because every case is unique and some cases might not be covered. A lot of our, customers find comfort speaking to a financial advisor before, they get onto the path of choosing the right portfolio for themselves.
Okay, so on the global on the global portfolio, I guess that's where I read about the risk parity style that you guys input in it. That's what you meant by managing the risk.
Absolutely. Right? So we blend the GMP, which is like the Nobel Prize winning, the Markowitz theory of the global market portfolio per se, and we blend it with risk parity, which was obviously made very popular by Ray Dalio at Bridgewater. So we somewhere bringing the best of these two strategies in one piece and then launching it to our consumers.
Which risk parity technically is only for very high net worth investors, right? But you make it available to the retail.
Exactly right. I mean, it's quite unique that optionality is now for the first time available for retail, because typically, like in banks and all, to do this, you have to invest millions and millions of dollars to even have someone to have that conversation with you. Let's put it that way, right? So,
okay. And who are the team behind this Syfe global portfolio? Are they like a special team for each of these portfolios, or is a entire team that's looking after all three portfolios?
Yeah, so I mean, the overall team at Syfe, we're almost coming to 35 people now. So there are quite a few people to, that meets the eye. I'm just one out of 35 employees of Syfe. I'm also an employee of Syfe. So I'm just one of the 35 people. We cover across different functions like technology, like distribution, like customer support. But I think some of the key people, I think, which might be relevant, for us to see might be, the investment team, right? So as you can see, right, myself, most of my career was, with, leading like ETF distribution as well as portfolio trading at UBS. Ritesh, as I mentioned about earlier, was a former advisor at Goldman Sachs and former to that a VP at market risk at Morgan Stanley. And then, of course, we have Richard and Akiko. Richard comes with a glorious past. I mean, I could make a whole slide on him himself, but, he's, was most recently a professor at NUS where he was teaching portfolio construction and risk management. But prior to that, has a very illustrious professional career also as a senior director at Lion, as well as a CEO of UOB Venture Management. Akiko is probably the smartest people I've worked with. She's a PhD, a quant, was a fund manager at Tokyo Marine in Singapore, and then has been with us for the last few years, helping us build out the strategies in a scalable and effective manner.
Okay, so basically, the whole team looks after all three portfolios, right?
Correct. Yeah, I mean this team, and then we also have like the other, other members of the investment and advisory team, which actually pick up. But we look at it as a team basis.
Okay. And which means if let's say I'm a new investor, I'll just go on the onboarding, and then after that I'll figure out which portfolio is more suitable for me. And if I have more difficulties, I will call the hotline, and fix a consultation time, and I'll get more advice from there.
Absolutely. You can actually, there's a little button, you can set up a time right there, and then from your panel itself for an advisor, you can see their calendars and when they're free, and they're generally fairly busy, but somewhere in the next week or so, you should be able to get a slot to have at least a quick catch up with them to understand, if the solution is right for you and all. Because The thing is, Alvin, for us, right? I mean, we as a business don't really benefit if users come for a short time and they leave us, right? And that's why, we don't have any sales charge or entry charge and so on and so forth. So we generally want to democratize investing. We generally want to build something that people will use for years and decades to come. That we want to build something that you will tell your friends about, right? And the only way we do it is by being radically transparent even before you come on board. So there have been cases, right? I'll give you an excellent story. About 2 or 3 weeks ago, I had a student who reached out to me. He said, I have taken student loan for which I'm paying, 5,000. Sorry, I'm paying like 5 or 6%, annually as interest rate. But recently I've had a windfall. So I'm suggesting, like, I'm thinking, should I pay back my loan or should I actually invest? And we were like, well, if you're going to get a 6% guaranteed return in this environment, it's actually not bad because that is guaranteed, right? Because you're paying that away. So we actually told them, and it was a meaningful amount, but we told them that, like, this is not the right thing to do, because it is for our interest, to be honest and to be transparent to our users is the only way they will, stay invested for a long run and also talk to us about their friends. And this is something that we do at Syfe. And that's why you will realize when you speak to our advisors and all, they're not going to be the salesy types trying to convert you, because the conversion doesn't really matter. For me, a client is converted when they are with us for the next 5 or 10 years, right? Which is what we intend to do.
Right, that's a nice story. And on that note, right, is there like a minimum age that you can take in for Syfe?
It's 18 by law, because under 18, like, they would still need to be nominated. And also typically if they're under 18, then typically the parents open an account on behalf of their kids, which is possible with Syfe as well. So you can just reach out to an advisor and we can guide you through the process.
Okay, so I can put my kids' ang pao money in Syfe under my name.
Absolutely, yeah, you can do that.
Okay.
Yeah.
Okay, and back to the REIT Plus portfolio, I'm quite interested in that, in the sense that I do know that there are REITs ETF nowadays, right?
Yeah.
And is the underlying an ETF or is a pure replication by Syfe?
It's a pure replication by Syfe. I mean, we are actually replicating the index, and that is great for the users because we are buying the underlying, REITs. So there are no ETF charges, right? So even compared to the cheapest ETF, Syfe becomes much cheaper because you're not paying the ETF fees. And on that, there's no brokerage, custody, all those other charges that you have to keep on paying. Plus, no need to set up an account, so on and so forth. Plus, I think one of the most beautiful advantages of a dividend product is the capacity to reinvest. And we don't talk much about this, but we probably should. We ran some numbers, and if you end up reinvesting your dividend that you get from REITs, right, on a regular basis, if you reinvest as soon as you get it, on average, you can make about 50 basis points extra a year, right? Which is a lot, right? Which actually pays for your entire fees if you think of it, right? Like, at least for a black tier and all, it pays for your entire fees. And which makes sense because if you think historically, REITs somewhere have been giving 8 to 10% return and 5 to 6% dividends, right? So if you multiply the dividend by that return, it comes back to that number, right? And this is something which people sometimes forget, and sometimes they don't do even if they know, because let's face it, even if you've invested $100,000, the dividend which you might get paid out might be $100, $200, right? Because it gets paid out in tranches, right? Only one of the REITs will pay out dividend. You really can't invest the $200 because when you go to invest the $200, you have to pay $10 minimum for, brokerage, right? So nobody's going to pay 5% away for, right, on upfront, right? So nobody invests it. But this is the beauty of a setup like ours, because you can put a small or big amount. We will actually just automatically, we in fact our auto default setup is automatic reinvestment, which I think is a great benefit and great advantage to our users.
And what's the minimum amount to invest in this REITs Plus portfolio?
Well, you can start with $1, but I mean, if you're going to get a 10% return, you will make 10 cents at the end of the year, so it might not be very attractive. So you can start with as little as you want. Typically, users start around $5,000 to $10,000, but you should put what you're comfortable with, and you can start with a lower amount as well.
Okay, but I think that is the point, because it helps investors with much smaller capital to start investing, right?
Yeah.
Like what you mentioned, if let's say you have to invest in ETF, even a REIT ETF yourself, you need to pay minimum commission.
Yeah,
which means you must invest enough to justify the cost.
Yeah, commission and like round lot sizes and all those little things, and then the dividend treatment. There are a bunch of these things which are not, like, let's say, fun to handle. Let's put it that way.
Okay, okay. So, and the interesting thing is that what I see is if let's say robo advisory really be the mainstream kind of investment in the future, that means ETF will play a much smaller role. Am I right to say that?
Well, yes and no, because I think ETFs play an incredible role in, building portfolios, right? So even for us, for example, right, for our global portfolios, or even let's say when we buy Singapore bonds, if we have to, we prefer to go via ETFs because they allow access to certain classes which might be very tricky to access. So to give you a simple example, right? We have in our global portfolio emerging markets, right? Now it's much easier for me to go and buy one ETF which allows me access to an emerging market, versus me going and trading China, India, Brazil, Indonesia separately, right? So I think I think if robo-advisory advances, ETFs will only play a much more significant role. In certain cases where the underlyings are all in one market and it's a relatively small index and all, there might be more value to do it. Now, for example, if the ETF charges were 5 basis points, we would have considered it, right? But at 65 basis points, I think it's unfair to our users to be paying for that, right? But they can't keep it at 5 basis points because they have their own underlying costs and structures, right? So I think the human tendency to optimize both for us as fund managers and our customers as end users will always lead to the most optimal solution. And I think ETFs are here to stay by far. I think they'll only increase and get more adoption as time passes by.
Okay, okay. So what I'm hearing is that there'll still be some implementation or execution challenges for those more broader kind of
Or broader,
asset base they're looking
or
for.
like bond-based ETFs and all, which are
Okay,
tougher to buy. Wherever there is a tricky to access the underlyings, there'll always be a
okay.
demand for ETF. Yeah.
And the reasons can be liquidity or just very larger quantum like bonds usually will probably only the insti will be able to buy them, right?
Yeah. And liquidity and even transaction cost, right? Because if an ETF manager is doing for a much wider amount, they'll be able to get much better preferential rates and so on and so forth, right? And that's why it's easy to do through them than us doing it ourselves.
Okay. I see a few questions. All right. Let me just pull it out and I can just put it across to you. All right.
Sure.
Kang Hao was asking, I just verbally read his question. I read through the synopsis for the Equity 100. The marketing materials quote pharma and French for their research on factors such as value and small size. And then there's a leap of logic where Syfe picks growth, momentum, and low volatility as the prevailing winning factors.
Yeah.
In that case, quoting pharma and French seems like a red herring in the first place. How do you identify, justify, and pick winning factors? Yeah, that's his question. I guess because probably the marketing materials was mentioning quite a number of factors, right? So probably why did the investment team decided on these factors?
Yeah, it's a great question. So this is actually a much longer discussion, right? So what I would strongly suggest is I think not this Thursday, but I think next Thursday we have a deep dive into our methodology and how do we actually build our portfolios. We did the same thing even about last week when the launch happened. So when we were building our Equity 100 strategy, right? So the idea was what are the different aspects that can help us to get that additional kick on beta, or so I should say a smart beta, right? So from our perspective, we ended up using pharma fringe factors because in back testing, when we ran those numbers, we realized we could actually get a much better and a much higher Sharpe ratio, right? So these factors definitely go into play. I probably, for the sake of this discussion, I think it might not be wise to have a deep dive on it. But what I can suggest to you is that, you can drop me a personal email or send an email to support@Syfe, and we'll be happy to have a longer discussion with you to explain to you exactly what this works. Or alternatively, you can feel free to come and join our seminar on next Thursday, where we can do a deep dive onto this.
Sounds good. It's getting too technical, right? So let's leave it to
I
another
mean,
session.
we can take half an hour out, and I'll need to get some slides together to run you down, because we had done this last week when we had done one of the launch events. Yeah, so.
Okay. So just join future Syfe events where they will probably have a deep dive on how this portfolio will be constructed.
Yeah, or feel free to send us an email to support@Syfe, and we will come back to you with an answer in less than 24 hours, right? So I think that'll be probably like the wiser thing for the audience that you have involved.
Okay. And there's another one in the audience, Sin Min. He's asking, do you have a financial advisor based in KL? So I suppose you don't offer the services to outside of Singapore at this moment, right?
Yeah, we don't actually. I mean, because we are licensed in Singapore, but we can guide them on some high level metrics and all as a prudent company, and then they can try to. This is anyway over a Zoom call, so they can probably have a conversation, but will not be able to give that detail of advice that we perhaps give to people in Singapore.
Okay. So is it even possible if they travel all the way down to Singapore to do it?
I mean, there is lockdown, so we don't like really, we will probably still stick to Zooms. But if you reach out, if you set up an appointment, we can probably see what we can do best for you within the legal framework of optionalities right now.
Okay. Okay. And I understand the REIT class portfolio is a direct replication. So I would suppose the other two portfolio will be mainly based on ETFs, right?
Correct. Exactly. Correct. The REITs is very going by the underlyings. The other ones we end up buying the ETFs itself. Yeah.
Okay. And I also understand that the 100 portfolio that is based on smart beta.
Yes.
So I also suppose the underlying will be smart beta ETFs.
Well, so it's a blend. Let me see if I still have it here. I might have it. This is it. Yeah, actually, I don't know if I have a slide out here, right? But yeah, so essentially what we do is we try to get a broader exposure where we cover, the more conventional S&P, developed markets, emerging markets, right? In the so-called, I guess, market portfolio. The smart beta actually comes from a blend of, growth and us trying to optimize on sector vol ETFs. So what you will see is a technology ETF, but also a few sector ETFs, because we've seen these sector ETFs end up outperforming, just the broader, index per se, and us having that in allows us to get a little bit of, upside on the beta. So I think there are two pieces that actually end up building the smart beta component of the strategy.
Okay, so it's not just pure smart beta ETFs now.
No, of course not. We choose underlying ETFs which are not classified as smart beta ETFs. I mean, then anyone will just go and buy them as themselves. We use like the most popular sector ETFs, and we use QQQ, which is an ETF which tracks the Nasdaq. But we control the components in a way so that we can get that additional upside for our users.
Okay. And which is your favorite portfolio?
So I'll tell you how, I have a blend of portfolios out here. I personally, I would say my significant amount of investment is in the global portfolio, which is risk managed, right? I think the global, 15 is a great portfolio because it's a good balance of equities, bond, and gold. But recently what I've done is that I have actually added up some broader, components of equity 100 as well as REIT 100. Because that is for me to get my upside, right? So I still believe that I'm young and I can still afford to, let's say, lose money. But the way how I think of it is that I at least in my mind, I think of a core and satellite. So I think my core becomes global, and then my satellite becomes the equity 100 and REIT 100. And for some people, the core becomes CPF and SSBs, right? And then the satellite becomes equity 100 and REIT 100. So I would say my favorite is still, I would say the 15% DR. I think it's a good balanced portfolio. If I had to choose one thing, and if that was the only portfolio I could choose, I would choose that. But I use a blend because it solves the purpose I'm trying to achieve.
Okay. And among your customers, which is the favorite portfolio then?
I would say, interesting. The equity 100 has got really good traction recently, right? Because it's just launched recently, but very, very good traction. Obviously, the most prevalent one is the global, but that's just been because it's longer. But if I have to put purely on basis of what is the most popular based on purely numbers, I would say it's probably the REIT portfolio. I would say that because, given the time it has been present and the kind of traction it has gained, I would say it's by far the most popular per se with our users. Yeah. Everyone likes a little passive income. Let's put it that way, right? So
there's an observation that I have as well, because Singaporeans are very into REITs because of the cash flow.
yeah.
There's always a saying that Singaporeans are asset rich, cash poor. So REITs become a godsend, right? Because you can get a lot higher yield.
Yeah.
through the dividends that the REITs provide.
Yeah, and also like capital appreciation, right? I mean, over time, if you see it has appreciated, and over the long run, I mean, short run aside, I think everyone has agreed that okay, the COVID impact, everyone overrated the impact, and so on and so forth. Because when we launched, like we launched it in Feb, right? Everyone's like, what are you doing? Like, why are you launching it in Feb? And we realized, like, or rather, we hope that investors who come and invest with us are not investing for 3 months or 6 months, but they're investing for few years to a few decades, right? And then they will find a value in coming back to my original theory of keeping our cost low and having a well-managed solution, which is what we offer.
Okay. Would there be also advice for the clients to switch among the portfolios, or they will just stick to what they have invested in the first place?
Yeah, I would say stick. After savings, the second biggest thing is tinkering, whether you're changing risk levels, moving from here, so on and so forth. See, you spend some time one-off to make a plan. Spend some time. Syfe gives you a complimentary advisory session. Use it. Like, talk to these people. They might tell you, okay, 50% goes in REIT, 25 in global, 25 in equity, 100 of your entire investable sum. Then after that, you stick to it. Because if you're going to be looking at it, I know this is boring because a lot of people want to believe that they can take calls. I mean, for that, you go to your broker, right, and buy Tesla or buy whichever stock you want to buy. But sticking to your investment plan and not tinkering is actually very, very important, right? Because, what happens is sometimes when people tinker or they exit and so on and so forth, right, they sometimes, end up missing some really good, opportunities. So like, I'll show you on this. I don't know if I have it here, but let me see if I still have that screen, right? I'm trying to see if I let me see if I have it. Yeah. So this is the thing, right? Where we just said, right, like, if you just, let's say you withdraw, you move from high risk to low risk and so on and so forth, right? Just missing 3 months of your, recovery can, reduce your returns, significantly, right? And as you can see in this chart, right, I mean, you can see if you stayed invested versus missing the first month, second month, and, 6 months, it can be very, very significant, right? So we always say, like, don't like try to, time the market. The time you spend in the market is the real draw. So if you stay invested, right, and if you don't tinker too much, it's there, right? I mean, if the very fact that you can stay invested in one portfolio means you can stay invested in the other ones, right? So don't get too much into these call takings. Make a plan and stick to it, and we are here to help you to build that plan if you need.
Okay, but doing nothing is very difficult, right? So
I know.
the easiest way is to lock their money.
Well, the fact is, let's put it this way: it's not that you are doing nothing. Syfe is doing it for you, right? We are managing your risk, or we are reinvesting your dividends, or we are ensuring that our portfolios are generating smart beta, as the case might be, right? So I would say that with investments, right? Again, if you have the time and energy and effort to come ahead and do it, by all means, go and do it. But think of it like, when you come to a platform like Syfe, you're doing it think of it more like a passive investment. If you have active use and all, traditionally, you're better, to do it through a broker, and compare the two, and you might be surprised which performs better. No bonus for guessing, right? So
I suppose Syfe do not have any lock-in periods. Anytime the investor want to withdraw the money, they can do so.
Anytime, no lock-in period, no withdrawal charges. You can withdraw anytime, and in fact, we're actually quite good with it. Now, most of our users, 95% of our users, if you send a withdrawal instruction before 11 a.m. today, the funds will reach your account by tomorrow evening. So it's actually very, very quick now. We've become very, very good at this, and we'll try to make this even better.
Okay. And how about the costs? Are they the same for all three portfolios?
Yeah. So the way let me see if I have that here as well. But our portfolios, the way how we are structured is that the cost is a sum of your entire invested amount. So whether you invest $1 in one, or you invest 100,000 in one, it's basically the same across the portfolios, and we will see the combined value invested with us, right? So we have 3 tiers. When you start, it's 65 basis points, or 0.65% all inclusive. If you come into a black tier, which is over $20,000, the cost is 50 basis points. And that is for the entire amount, right? It's not like only over 20,000, for the entire amount, right? And if you go over 100,000, then the cost actually reduces further, and it becomes only 40 basis points. And if you're over $500,000, then reach out to us, and
not hire you,
custom solutions for you. So essentially, we look at the entire value that you've invested of the portfolio, and you could have it in 1 to multiple portfolios as you might be comfortable with.
Okay. So it makes it very simple, right? To just remember the three
Absolutely,
tiers.
yeah,
Okay.
absolutely. If your amount is over 20,000, it's 50 basis points. Over 100,000, 40 basis points.
Okay, there are a few more questions. Let me just put it out. He Yuan was asking, how is your global portfolio versus three-fund portfolio? Home ETF, IWDA, and one local bond. Okay, I think he's asking that two questions actually. One is that how is the global portfolio uh, performing versus let's say self-made three-fund portfolio where there are two equity and one bond ETF.
Two equity and one bond ETF.
Yeah.
So, I mean, it's somewhere like not an apples to apples comparison, because at the end of the day, two equity, one bond ETF is probably closer to, I guess, two-third equity 100 and one-third a bond solution, right? If you look over a duration of time, over a very long duration of time, we've spent enough time, and what we compare ourselves is a benchmark which is called Morningstar. So if we look ourselves, and you can see these numbers are publicly available, we are actually beating the Morningstar, moderate benchmark. Let's say for the 15% downside risk, right? Now, if you're talking of a custom portfolio that you have made, uh, if you look at it over a long duration, I probably want to believe we'll be beating that also. If you're, when I say long duration, not of a few years, over a short duration, maybe the last 3 or 4 months, I want to believe we might not be beating it because our views, the risk is still on the higher side. So we are still conservatively positioned with our global portfolio because, to some extent, we believe that this market rally is a little extreme in nature, right? So our view is that, that we still want to manage risk of our customers and their portfolios, and we want to protect the downside. The focus is out there, right? So if you purely look at a return basis, then I would say in the 3 or 4 months, you might find the global portfolio is probably slightly underperforming, a more equity heavy portfolio, purely because our global portfolio will have a lower allocation to equity.
At this point in time.
At this point in time, absolutely. And it's a dynamic number, right? I mean, like this 15% DR right now is at 30% equity allocation. This portfolio, if you go back earlier this year, was at 75%, 77% equity allocation, right? So given the recent last rally has been driven largely by the equity price move up, this portfolio is not there. But again, this is, again, one of those things where if you're looking at a 3-month horizon, you will always find a time when one portfolio will outperform, other one underperform, and vice versa, right? But if you go over a period of time, you will always and always see that this will actually end up being a winner. And you have the downside that if, there's a second wave of correction, somewhere, Syfe is managing that downside for you.
Okay. Next question for Mimo. He's asking, how is Equity 100 portfolio structured to mirror S&P 500 based ETF like VOO, which tracks the main indices? Correct me if I'm wrong, but Equity 100 comprises large cap stocks. Wouldn't you say that big caps are overrun at the moment, so the margin for growth is somewhat lesser than the small cap stocks?
Yeah, I think, let me see if I have that here also, right? So essentially, this is an interesting point, and so essentially we use about 10 ETFs out there, right? And given the view that we've always, had out here, as you can see, right? Our views are actually small caps will continue to underperform relative to their larger counterparts, right? And that's why there's a intentional tilt, which is towards larger cap, stocks per se. Also bear in mind, if typically if smaller caps actually end up performing well, then traditionally they no longer remain small caps, they end up becoming mid caps or large caps, as the case might be, right? So for us, when we build out, the three factors we see is, of course, we look at growth, right? And typically growth is truly only seen in mid or large caps, right? In small cap stocks, typically it's a bit of a misnomer, right? It could be one good quarter and the next quarters could be bad, right? Secondly, of course, the typical concern with small cap stocks is that they're generally very volatile. They'll move like plus minus 20% in days, which is something which, many people might not be, comfortable with. And our goal, of course, is to ensure that, we have the highest, I guess, returns for the volatility we have. And then again, coming to the point that specifically addressing on large cap, right? Our view is that large caps will continue to, outperform. And as such, you will intentionally see a tilt towards large cap stocks out here.
Okay. And another question from Chingli, and she's asking, is Syfe investing in USD or SGD? So I guess she's asking because some of the underlying probably ETFs that are listed overseas and they're in US dollars. So that's why the question.
Yeah, great. Yeah, so you as a customer can both move USD and SGD, whatever you prefer. When our global portfolio and equity 100 invests in USD based ETFs, like USD, domicile ETFs. Of course, the ETFs itself are global in nature, right? They can emerge in emerging stocks and European stocks and gold and so on and so forth. So when you invest in a global or an equity 100 portfolio, typically if you move SGD, we convert the SGD to USD for you, and this is at an incredible rate of just 10 basis points or 0.1%, which is charged by our broker. And it's a very special price. Otherwise, if you do it yourself, you probably have to pay like 50 or 60 basis points or 0.5, 0.6%. So we'll convert it for you if the case might be. If you move USD, we can invest it straight out in USD as well. The REIT product, as you know, is Singapore dollar denominated. So we actually end up investing in Singapore dollar, and majority of people move SGD, and we invest it only in SGD. So depending on the portfolio, the base currency is either SGD for the REIT or USD for the global portfolio.
Okay, right. So there are no more questions. Okay, and I think I've taken up 1 hour of your time. Maybe the parting message would be, if let's say someone in the audience is interested to sign up for Syfe, how would one go about it?
Yeah, it's super easy. So, we have a beautiful app and also the website. Sometimes people prefer the website because it's a bigger screen and they can read things out. But we have a risk analyzer, which will give you a portfolio recommendation. It also adds a forecasting tool. You can put, the amount you want to add as, your lump sum as well as monthly. Monthly is completely optional. We suggest it, but it's completely up to you. There is no penalties and all if you don't do it. And transfer the funds and you're done. As simple as that. I mean, the entire process should not take you more than about 5 or 10 minutes, because we onboard via my info. And of course, there's a nice little button at the bottom right of your app that you can click to set up, either speak to our customer support, set up an advisory meeting, and so on and so forth, right? So it's completely self-driven. Of course, if you have any concerns or any questions, feel free to drop an email to support@Syfe, and we'll be happy to guide you through how to set up your account.
5 minutes, okay? Shorter than a Netflix episode. All right. So
absolutely,
get
absolutely.
it done.
And for a gift that keeps you giving, right? So
okay. Thank you. It has been a joy talking to you, Dhruv.
Likewise, Alvin. I mean, it's interesting we meet over Zoom, and thank you for having me over, and thank you for your insightful questions and your time. Really appreciate it.
Okay, so thank you all the audience for joining us today. So if you are interested, you can just download the Syfe app or go on to Syfe website, which is syfe.com. Right? It's very easy to remember. And remember to join the future webinars if you want to know more about their portfolio. There'll be some deep dives into their portfolio construction, philosophy, etc. Okay, so thank you very much for joining us. Thank you, Dhruv, and we'll
Thank you, Alvin. Thanks for having me.
Thank you.
Thank you. Cheers.